Thank you, Lori. Thank you for incredible questions. Thank you, Rachel, for talking us through how it really happens at Salesforce and taking these things on. And Toyin, we see you very much. Thank you so much for being such an incredible entrepreneur. You are an inspiration, and we were all looking forward to this panel. And this panel was everything we hoped. So from founders for incredible entrepreneurs like Toyin, responsible innovation sits at that nexus of funders and founders. And where we're going next is to hear from the investor perspective. So I'd like to welcome our incredible panel. John Zieger will moderate. Please come on down.
Well, thanks. Well, better. Check, check. Okay, great. What an awesome panel. That was a fabulous conversation and set us up really well. So thanks again, Toy and Rachel, Lori, for that. You know, in many ways, venture capital decides what kinds of businesses get built, and maybe more importantly, which ones get scaled. And so I'm really excited to have this panel of venture capitalists who are walking the walk of responsible innovation in very different ways. Tim Wang is the managing partner of the Wesley Group. Laura Weidman Powers is a partner at Base 10, and Clara Brenner is the managing partner of the Urban Innovation Fund. And we are excited to have each of them here. And let me start with a kind of a general question. I'll just, for this one, I'll go down the line. We'll try to make it a kind of pretty interactive conversation overall, but we'll just sort of start with a little bit of an opener here, which is maybe say a little bit about your firm, your kind of general approach and thesis, and where responsible innovation, and you may use a different term, so we'll be able to talk a little bit of nomenclature here as well, where responsible innovation fits in. And Tim, I'll start with you.
Good morning, everybody. So Timothy Wong with the Wesley Group. So we're one of the early kind of climate-focused sustainability venture funds. We've been around since 2007, kind of one of the OGs, if you will, in the climate space. Oh, can you hear?
Oh, yeah, sorry. And our last panelist, who I didn't think was going to make it, so I sliced him off the panel here. It's Quentin Clark from General Catalyst. Quentin, we'll get you into the conversation in just a second.
No worries. So we've been focusing on climate sustainability since 2007. We've just launched our fourth venture fund back in January. It's a $300 million venture fund focusing on energy, mobility, smart buildings, industrial tech, as well as cybersecurity. So we've been around for 4 funds. We're actually raising a seed fund now, and we've just been really thinking a lot of this from an energy perspective and the energy and mobility nexus from day one. So we were early investors in Tesla. That's obviously done relatively well. But we're looking at the next wave of entrepreneurs trying to focus and usher in this energy transition.
Thanks. So there we go. Hi, folks. I am a partner at Base 10. We think about our investing as investing in automation for the real economy. And for us, that means looking at how technology is mashing up with legacy industries. And another way that we talk about it is who are the entrepreneurs that are solving problems for the 99%. We have 3 early stage funds that we've raised. We're deploying the 3rd right now. And then about a year and a half ago, we raised our first growth fund. And that fund is called the Advancement Initiative. And while the firm has had a bit of a DEI focus from the beginning, we're the largest Black-led venture firm. And we have pledged 1% of profits in perpetuity to racial equity. The Advancement Initiative, this growth fund, was sort of our next big leap there. So the Advancement Initiative it's a returns-focused fund. We invest in category-leading technology companies across that automation for the real economy thesis. But then we've structured the fund to close the endowment gap for historically Black colleges and universities. So we both have a set of special economics for HBCU endowments to participate in the fund. So our first fund was about $250 million. Most of the investors were foundations, family offices, et cetera, participating at traditional VC economics. HBCUs participate fee-free, carry-free, and with no minimums. And then we, as a firm, donate 50% of our profits from the fund to HBCUs and other nonprofits that are building pathways into tech for underrepresented minorities. So we can talk more about what that looks like and how that sort of transformed the conversations we're having with founders. But it's really been the sort of big escalation of how we think about our purpose as a firm in the world.
Hi, I'm Clara with the Urban Innovation Fund. We're a venture fund based here in the Bay Area. We back startups shaping the future of cities. Basically, that means any company touching the livability, sustainability, or economic vitality of our urban communities, all at the pre-seed and seed stage. We are a market rate fund, but we do lead with our values. On an annual basis, we issue what we call an urban outcomes report, which essentially looks to quantify and add some color to the real world work that our companies are doing in cities. We also track things like the diversity of our team, the diversity of the companies we invest in. So for example, 79% of the companies we've invested in to date have a woman or person of color on the founding team. So it's something that's very authentic to who we are. We're investing out of our third fund, which is 101 million pre-seed and seed stage fund, plus a $23 million opportunity fund that we closed just a few months ago.
And Quentin.
Hi, I'm Quentin Clark. I'm a managing director at General Catalyst. General Catalyst is a full stack venture capital firm. We're in our 11th fund right now, over 20 years since our founders first started the firm. And the firm has a mission to invest in responsible innovation and help companies create enduring companies that have a positive impact on society. So we're happy to be part of this as well.
Fantastic. Maybe let me start, and I will sort of toss this one around a little bit. But a recent study from Sifted found that 96% of Gen Z founders say that they would reject an investment offer if they felt the investor was not ethically aligned. How do you think that changes VC, and do you see that manifesting in your practice and what you're doing already? Maybe Clara, I'll start with you there on that one. Does that?
It's a lie. I mean, I've seen it. We have many of our most sort of like bleeding heart, lead with the world positive mandate companies. You get a term sheet from XYZ investor, let's call it, and whoever has the best terms, like it is a very difficult conversation. So I think to some extent that is true, that I think what employees want, what founders want is evolving. But I do think when faced with the economic realities of running an early stage startup, it is a much harder decision than perhaps that study implies. At the same time, I do see an evolution, especially from the institutional investor landscape in terms of their expectations of general partners. So for example, 95% of our capital comes from institutional investors. So these are university endowments, foundation endowments, large hospital systems, pension funds, et cetera. And I would describe all of those as very traditional market rate institutions, but I would also describe them as maybe impact curious. This is the word we use internally, where first and foremost, they care about making money, but they're also interested in starting to align some of their investment practices a little bit more closely with their organizational objectives. And so they're looking for funds, like if they're going to add any funds in the next few years, which is TBD, they're going to be folks that I think speak to some of the interests of maybe their pensioners or their employees or folks around the table who don't want to see concessionary returns, but also want to see things that are a little bบmore aligned with the work that they're doing. So like you have a hospital system where kids are coming into your emergency room with airborne related asthma. And then on the other hand, you have, the investment side of the business backing oil and gas. And so there's just like a real mismatch between what one side of the business is doing and what the other side is. And so I do see that conversation evolving actually probably more quickly than many people expected. But I would say from like the founder perspective, in terms of like which check they're going to take, I think it's a little optimistic.
Quentin, I'm curious from your perspective, GC, very large traditional venture firm. I think there's been a lot of work, particularly over the last couple of years, to really rebrand and reorient the firm around responsible innovation. A lot of your work has focused on that. Is that driven by what drives that? What is that what you see in terms of founders? Is it other trends? Why make that change?
Yeah, I guess I would start just by adjusting a little bit of that language. It's not a rebrand as much as it's a trying to help ensure that the even internally and externally as well, that the alignment around responsible innovation is kind of understood, as opposed to really being a brand thing. We come at this from a standpoint that you want to build an enduring company. On the long term, you need to do things that are actually in benefit of society. And, the firm kind of comes from an ethos of trying to build long-term institutions, like really enduring companies that have this like long-term impact. And so we actually think these incentives are very much in alignment. You want to have a big impact, you need to be at a scale that can generate that kind of impact. And that means we need to find a way to make some of these venture backable endeavors. And so, kind of getting those things in alignment, keeping those in alignment, and having to help the world understand why that's important, I think is what's behind that. And, for us, there's, framework that we have around investing where, we look at business drivers, we look at their mission and thesis, we look at the founders and what they're motivated by. And we go through a process both as we look at companies, as we make investment decisions, as we work with founders to decide to work together, and then even as we govern. So this kind of shows up throughout the whole practice.
Laura, Base 10 is a little different. You described it a number of different ways, but one of the ways that you are different is, as a late stage investor, you lead with ESG messaging and ESG support for your portfolio company. I think part of the value prop is we will help you on your ESG journey, and we will help prepare you for public markets. How does that work? How is that going?
Yeah, it's funny. I think I have like a similar but maybe slightly less cynical view to the 96%. I don't think it's 96%, but we have seen founders make decisions based on our ESG and DEI offerings. Some of it is, I think, the stage at which we're operating. So the advancement initiative is a growth fund, and it tends to be that the founders, certainly those running category leading companies at that point, they have their choice of investors, and they're sitting there and investors are pitching them essentially. And we have had a number of occasions where it's the fact that we say, we embed purpose on your cap table, because by, at your liquidity event, we'll be funding scholarships for students at HBCUs. And then, as John mentioned, our portfolio support, which is the piece of the puzzle that I lead, is around how we make everything that we can around DEI and ESG, make sort of the hard things easy, and sort of the sticky things unstuck, to help these category leading companies really lean in on those fronts. And we have one of our founders, Iman Abu Zaid, who leads Incredible Health. When we were submitting a term sheet to lead their Series B round, they chose us, but we weren't the highest term sheet actually that she got. And I was talking to the CFO and I was like, hey dude, like what gives, how did we come out on top if it wasn't the highest term sheet? And he said, because we think we can create the most value with you because of the values alignment around DEI and ESG, because that's incredibly important to how we build our company. That it might not be the highest term sheet, but we think it's going to be the highest value company as a result of that partnership. And so I do think there are more and more founders who are thinking that way. Either it is sort of feels values aligned with them, or they understand that it is the way the market is moving, that their employees are demanding that they are more cognizant of DEI, of climate impact, and that if they're able to partner with an investor that can support them, that they'll actually outperform as a company in addition to living their values.
You mentioned climate, and that gets me to a topic that Tim and I were talking about just a little bit before. I'm curious to get, because Wesley has been in climate before it was the new thing, and you talk about through the lens of sustainability, but it's clear with the Inflation Reduction Act and a bunch of other things that a great big dump truck of money just kind of got backed up to the innovation economy and climate. And if I don't know if your LinkedIn looks like mine, that what everybody's saying is if you just got laid off, go get a job in climate. That's where the new thing is. So everybody who is thinking about responsible innovation, sustainability, these things, is thinking about climate. How do you think about those trends, and how do you think working with companies in this new environment?
Yeah, thanks. I think this is a paradigm shift for our industry, right? So I think we saw the first wave back in 2007, 2008. I think the missing piece was demand. There was no demand for all these things, whether it's electric vehicles or batteries or solar panels. And that's fundamentally shifted, both from consumers, but also businesses. One of the key things for us in terms of our priorities, we obviously put in an ESG and a D&I clause in our term sheets. We want to show from day one that there are expectations with our capital around reporting around D&I. But then on top of that, what our goals are to accelerate this transition. And so part of the way we do that is to partner with a lot of strategic firms as our LP base. So we're talking about Alaska Airlines, Duke Energy, Audi, the car company. These are firms with also net zero goals, trying to find the best technologies to accelerate the transition and meet their goals. And so if we can provide that, I think that is something that's completely different from where the world was even just 5 years ago. And to put the IRA on top of it, you've just added a huge amount of wind behind our sails heading into the next decade or two.
So this is a Responsible Innovation Founders Summit, and we've got a lot of different people here. We've got investors, we've got operators, we've got others, but we want to speak in a meaningful degree to founders who are thinking about who they put on their cap table and how they might work with investors. A couple of folks have touched on this already. Maybe Quentin, I'll turn this one over to you first. A founder comes to you and they really lead with their values. They really want to get out there that we care about fill in blank what their values are. Is that the right way to approach you on that? Like how do you suggest, if you were coaching a founder who's thinking about taking investment, how do they have that conversation to get values alignment with their investor and send the right signals and avoid sending the wrong ones?
Yeah, I mean, kind of assuming that the rest of the discussion around the company, the problem space, the build, etc., is kind of aligning and making sense. We will, if the founders don't raise this, we often will raise this ourselves and want to have a discussion with founders around their values and how they want to build a company in terms of culture and impact, as part of even the investment process and getting to know the founders. And there's a handful of examples. Maybe one of them could be helpful, but when I was investing in a company called Lesson, which is in the prop tech space, and I won't go into the details of it because it's not particularly relevant, but there's a set of vendors that the company works with to get work done. This is hands-on remodeling work and this kind of thing. And the founder and I had a discussion around how does he think about that population of workers? What does he think he can do for their lives? And we kind of realized that we had a lot of alignment around the ability for this company to improve the state of their work, keep them fully employed and fully busy, pay them on better terms than what they're getting, provide safety around them, et cetera. And so we had that conversation, before we wrote them a term sheet. And and then that kind of spills over into governance at some point as well, and sort of how we engage, in terms of our board work and that kind of thing. But we think it's important to have that conversation up front. And the other thing I'll say about this is, there's some talk track in responsible innovation or kind of thinking about impact on society that says maybe some things that are being created in the world are not good for the world, so like we're not going to invest in them. And the interesting thing about it is, if the world, if something's going to be invented, if there's going to be a change in a business model, or if there's going to be a core technology that's invented that has a potential for very kind of broad impact or consequences that have to be thought through, you have to fall back on the following. You probably can't stop that from happening, right? If it's not this founder and this person, it's going to be something else. The sort of progress of society kind of, and the human race kind of marches on, and things will get discovered. If it turns out calculus is being invented in two places at once, right? Even though we kind of credit it to one source. But the reality is these things are going to happen. So then you're left with the question, who's the right person to bring this to the world? And if you can find the founder with the right mindset, that has the right values and the right motivation and wants a kind of a partnership, it's better to back that and get behind that and help shape that than it is to just let go of it. And an example of that is, we invested in a company called Kernel, and Brian Johnson is the founder of that company. His motivation for understanding what's going on in the mind, comes from a basis of how you positively impact, millions and billions of people, and it is deeply genuine. And so it made sense to us to get behind this and use this as a way to help kind of shape that outcome, as opposed to saying, gosh, understanding really deeply what's going on in the brain and like reading minds, etc. Like, that sounds scary. Let's just not do it. It doesn't feel like it's going to have good consequences. Instead, it's an opportunity to really engage in and back the right kinds of people behind ideas.
Yeah, that is a fascinating topic, and one that maybe if we have more time, I'd love to. Let's come back to, because I think it's super. But actually, let me take that as maybe the starting point for the next question, which is related, which is, and Claire, I'll throw this one to you. That Quentin's hypothesis, technology that we can help find the right founder who's got the right values and maybe help shape that technology. How do you use your relationship with companies over time, post-investment, to help shape more responsible outcomes? Like, what's your role as an investor and maybe a board member?
So we're early stage investors. So I think ultimately the impact or outcome that a company is looking to pursue is future hoped for outcome. And the most effective way that an early stage investor can help is through corporate governance. So things like helping you set up the right structures internally. If you haven't hired a woman in your first 10 hires, there's something wrong with you and we need to help you with that. Ultimately, like, those are the types of interventions that I think an early stage investor can do to be the most useful. I do want to back up for a second though, because I don't totally know if I followed Quentin's answer. I would like to put a fine point on it. No, you should not lead with your impact. You need to lead with your performance. Investors talk to thousands of companies a year, and you've got like 30 minutes to make an impression. You need to lead with your performance. And ultimately, your investors who care about world positive outcomes are looking for companies where that outcome or hoped for outcome is embedded in what you do. So it's pretty clear, like, you're doing a water conservation startup, or you're doing a solar panel startup, or whatever it might be. Like, it's pretty clear, like, the more solar panels you produce, like, the more outcome that's there. It's pretty obvious. Or like, if you show me your deck and you have 10 white dudes from Stanford on your deck, like, it's pretty clear to me what your values are. I can glean that myself. I think it's really important, and we often see these with companies who very authentically care about world positive issues. Like, they leaned a little too hard into it in a way that even the most aligned investors are not going to resonate with. So I just like to put a fine point on it. Please don't do that from my perspective.
Yeah. Laura, maybe I'll toss this one to you. in 2022, is responsible innovation sort of table stakes for VC? Like, how do you think about what is sort of the minimum that people should expect out of their investors? What do you think that looks like going forward?
Yeah, I think we are still very early days in sort of figuring out what the role of capitalist structures are in creating positive impacts, like how we think about the ways that businesses and investors internalize the externalities that they create in the world. I was having a conversation with someone recently. Actually, their teammate is one of the books who is here, the team from the Aspen Business and Society team from the Aspen Institute, talking about, the companies that are being started today, the ones that are successful are going public in, call it 8 to 10 years. So what they need to be thinking about is, what is the world going to look like in a decade? And what are the expectations going to be there? And how do you build a company that is going to be successful, sustainable, impactful, and what are the expectations of consumers and the market going to look like, not today, but in the future. And I think that I would say, like, employees are ahead of founders, are ahead of investors generally. And we have as an industry, a lot of catching up to do, and a lot of sort of reformulating the frameworks that we use around risk assessment. In particular, there's some news happening currently that underscores, I think, a lot of just the way that we think about risk, and what the different risk factors are in the 21st century that maybe look really different than what we've been used to assessing in the past. And I say this as someone who is both not an investor and new to venture, so giant grain of salt, but someone who's been sort of around the industry for a while, and thinking about impacts for the majority of my career.
My bingo card I can get to take my FTX bingo card, I think, with that, because I was wondering how long it would take for it to come up, and so maybe Tim, just I'll throw this one to you for a second, because some great investors invested in that company and made and obviously in hindsight made some bad decisions there, and we've seen any number of examples of that over the last decade. I will say, from being in-house counsel for a long time in technology companies, diligence is often kind of spotty, even in very big deals. Like, what is the role of venture capital in thinking about risk, to Laura's point, on deals like that?
Sure, thanks. I mean, I think there's a couple of things for us. There are different levels of risk, obviously, but we're trying to also apply some of those risks to ourselves when we talk to our LPs even as well, right? So when we look at startups, we have to look at them. We add not only clauses to the term sheet, we're adding extra diligence on D&I. We're actually having a separate deep dive diligence section on that. We're trying to understand, like you said, where the company will be in the next 8 to 10 years. Will that be successful for us? But that, at the same time, we're also committed to working with our portfolio companies, which is why we've made a net zero commitment ourselves as a firm, right? To show that we want to work with them, hands together, as well as our LPs, right? This is not going to be an easy transition across the board. And if we don't understand the risks ourselves for what has to happen day to day and how we can help our portfolio, then we can't properly examine these founders.
Claire, how do you think about risk and your role in as a gatekeeper? I mean, at some level, maybe you can push back if you think this is wrong, right? You're as an investor representing often LPs. I don't know who your LPs are, but often those LPs are institutions of various kinds. So there's some, at the end of that chain is some retail investor somewhere. You're a kind of gatekeeper and a decision maker about the risk. How do you think about that?
I think corporate governance is ultimately the key. Like, this is what the big discussion point is one of the discussion points is about FTX currently is like these investors were not taking board seats. We had our annual meeting this week and we had Jeremy Weinstein, one of the professors at Stanford who teaches an ethics class focused on the CS community. And he's done a lot of interviews with VCs who feel like on the one hand, they get all of this attention of being super powerful, like, we have all this money, we have all this control. But when he talks to VCs, they feel like they have no control. They're minority shareholders, they're fighting to get into deals. And ultimately, as in the case of FTX, they felt like they were either going to not get in the deal or they were going to have to make serious concessions around corporate governance. And Jeremy's thesis is really that investors need to band together a little bit more effectively in order to set some basic standards as an industry. He has a thesis around organization, essentially. Like there's certain industries like the medical industry where there are very powerful industry organizations that serve as gatekeepers themselves. Like you can't practice medicine if you're not licensed in certain states. And he posits that like maybe we need to be a little bit more organized ourselves to say like none of us are going to do this deal if you don't have a board or like if you don't have a CFO. And I think we're a really, really long way off from doing that. But until there is some kind of formal collaboration or standard setting for our industry, this is always going to happen. Like the FOMO that we feel is the same as the FOMO of our founder, where it's like, I could take this term sheet from this investor I feel like mixed about, but at a way higher valuation, or this really nice impact investor with these horrible terms and all of these real parameters that they're setting. And it's like, it's going to keep happening until there's some real industry standards.
You're singing our song at Responsible Innovation Labs, but anyway.
One thing I wanted to add too, just on some of that, in terms of diligence, right? Like you just said, you don't want to. One of the big things for us has been actually GP commitment, and that probably doesn't get talked about enough. And so for us, we actually ask 3 or 4% GP commitment, where the normal is kind of 1 or 2%. And I think that hits home to me, and especially my wife as well too, because every time we make a deal, I have to say, this is coming out of my pocket, and if I don't do the right diligence and it goes belly up, then that's my future, our future there. So I think it's very important to show that value and then show that alignment. And if you're putting your own skin in the game, you're probably going to try to make the right decision at the end of the day.
Yeah, super interesting. Quentin, let me throw this one back to you. I think one of the interesting questions for me in thinking about the space and talking to a lot of VCs is what kind of post-investment relationship with the company looks like. We've talked a little bit about that in terms of governance, but there's also things like disclosure of data and, really, I would say probably more tactical, but also important things about sort of knowing what that company looks like, not just in the early stage when you can have a conversation, but at scale. What does the team look like? What does diversity look like? What does their carbon impact look like? Probably other things that are important. How do you think about that? How does GC think about on an ongoing basis building the kind of disclosure relationship and just sort of rigor in the relationship that keeps companies on the right path?
Yeah, I mean, there's a lot to say here. And actually, some of it comes out of the conversation you guys were just having around the relationship between the VCs and their role in the cap table and the companies and founders. This is why we rather have concentrated positions, because when you have a large number of venture capital firms that all have tiny minority shares in a company, there's always a kind of who's on first question amongst even the investors, like who's really partnering deeply with the founders in the company. And so we like to be more in a position where we feel that sense of obligation or responsibility to be very deeply engaged with our companies. And then the ongoing work, a lot of this has to do with, can you get alignment amongst the board members and your peers from other firms around the table? And the North American Venture Capital Association, they're also trying to help set some standards here as well. But how do you make sure you have that alignment? And because if you work together with the founder, you're in a much better position to influence outcomes than if the founder is kind of hub and spoking and sort of able to kind of work across the board, one by one. Our ongoing work, we try to make sure that we have the relationship with the founder where we have a transparency of what's going on. Of course, in our investment work, we gain rights to all the sort of basic fundamental information. And then in an ongoing basis, we do ask that they start. We have an annual diversity poll that we do amongst our portfolio to understand where everybody is, where the industry is. We work with the portfolio companies to create D&I reports and focus and make sure they're digging into this, understanding where they are. It really kind of starts with that. And I like what was said around, like, if in your first 10 hires, you don't kind of start to have the right reach in terms of diversity, we start to engage in that conversation and not just like ask them the questions, but like hook them up with firms that can really help that kind of recruiting and help them kind of solve the problem. So I think a lot of this has to do back with those shared values and how you engage with the founders and how you kind of keep that conversation going. And in a position with many of our portfolio companies, like having that sense of responsibility to be their partner in working through this and building the company, not just like one of lots and lots and lots of checks into a company.
So back to something, Clara, you referenced, FOMO drives so much of what happens in the industry historically. I don't know if you've heard, there's definitely a downturn in tech. I want to make sure I break news today. Valuations are down. Companies are shedding employees. I suspect great companies that were getting 7 term sheets before are getting fewer. Has the power of venture capital firms relative to founders changed? Have the dynamics in the industry changed? Is FOMO going to be less of a driver? And maybe Clara, I'll ask you that question.
I wish I could say yes, but probably not. I do think we're starting to see more punitive terms, more information rights, just more general oversight, interest in corporate governance, which I think is generally a good thing. But fewer deals are happening, but there was just a study that showed, at least at the early stage, the average valuation at the seed stage is as high as it's ever been. It's still 10 million. And so I think it's largely driven by clean tech. Sorry, it's probably your industry. But like, we are seeing valuations drop in certain sectors, but on the other hand, we're still seeing like 20, 40, $50 million post-money valuations in sort of clean tech space, which I think is buoying that number. So maybe I'll say, like, depending upon the industry, maybe a little bit around the edges.
Or how about you? What do you think?
Well, I guess I'm just reflecting on what a bad decision-making framework FOMO is. And I think, my hope would be that a lot of the conversation is really more about that sort of longer term view on company building with that longer horizon versus willing to sacrifice, governance or, make all sorts of potential trade-offs or shortcuts because something's hot in both directions from investors and from founders. And that, my hope is that we're sort of, maybe Gen Z is a push here, but, towards, I do think the sort of generational perspective on work and wealth is shifting a lot. And I do have a lot of curiosity around how that's going to play out as we see more founders and more investors from sort of younger generations.
Let me ask one kind of macro question here, which is, I think given what you all do for a living, I think I have a sense of what you're going to say, what the answer is. But is the venture capital business model compatible with responsible innovation? Right? It is the 10-year funds, timelines of returns, the expectation, the kind of general power law of funds. Is that compatible with thinking carefully about governance and scaling responsibly and all of those things? And I'll open that up to whoever wants to take it.
Oh yeah, I mean, in some cases, like, I don't think that venture capital as an investment framework is going to get us all the way anywhere. I overheard the end of the last panel, and Toyin was saying that she is solving a problem where the social and financial issues are aligned, and that's unique. And there are plenty of really great businesses that could really use outside capital where venture capital is not the best model. And so I both think that there's a imperative for venture to kind of move towards, identify and adopt more frameworks that can and standards that can help with responsible investing, and sort of figure out how to set up relationships between investors and founders in a way that leads to positive externalities, world positive outcomes, however you want to frame it, and that we need new innovations around financing to create the types of companies, like the full breadth and spectrum of the types of companies that I think we need today.
You're asking fundamentally, is there enough at the intersection between what is good for the world and what is venture backable? Is that a big
I
enough?
think that's right. I think that's a fair, exactly.
Yeah.
Yeah.
Is that a big enough intersection to have a venture capital industry thrive? And the answer is yes, it is. We happen to be involved with City Block, and we can see that alignment and the power of that, and and the potential for the outcome there. But we look at this and we say there are going to be businesses and nonprofits and other sort of financial approaches, instruments that are necessary for some work to happen. And how do we even support those in a venture backable way? We have a company called Percent that is in the portfolio that's building rails for nonprofits to get access to more donors, et cetera. It's a B2B business, not a B2C business. And that's like an example of how do you facilitate and put venture as a lubricant, if you will, into the nonprofit world to accelerate their access to capital from where they get their capital from. And then on the other end, there are businesses that are good venture outcomes that are not responsible businesses. And we think very carefully about the investments we make, and there's things we've not invested in because we could not get our heads around whether or not the potential unintended consequences weren't worth the trade-off.
Yeah.
And you have to have the discipline for that.
Yeah. We're going to go to Q&A in just a second. I don't know if anybody else wants to weigh in on that question.
I can jump in and say, I think it's maybe the wrong question that we're talking about. Very few businesses, period, are a good fit for venture capital. Like, it's a very, very, very small percent of companies that could scale at a pace appropriate for a venture outcome, which is essentially like at least a 10x in 5 to 7 years cash. There are very few businesses, period. But ideally, all venture-backed businesses would be responsible businesses. There's certainly a spectrum of what those outcomes are. You may have companies building rails for nonprofits, and then you may have companies that have no explicit world positive outcome, but pay their taxes, treat their employees really well, are extremely diverse, are carbon neutral. Like, there are many ways to live a responsible outcome. And so I think that's just a really important thing. Everyone sort of touched on it already. Like, there are other forms of capital that may be appropriate for most businesses, period, regardless of whether you're world positive or not.
I think we have some questions from the audience.
Thank you, Tim. The first one is back to industry standards. And so the question came from online. What is the venture capital responsible innovation table stakes versus what's our aspirational goals? And we've spoiler alert, we've been in talks with Base 10 about, as John said, this is exactly where we live. So what's table stakes? What's aspirational? Where can we go next?
I think there's like what is right now versus what can and should be. table stakes are probably two slightly different things. I mean, we at Base 10 very strongly believe that fluency in ESG, commitment to DEI, that these things will be table stakes for outperformance. I mean, there'll be plenty of companies that get formed and funded and grow without thinking about these things or caring particularly about them. I think that will always happen. But what we're really interested in is if you as a founder want to build a category leading company, sort of an industry defining company, then how do you think about your not just how fast you grow, but the way that you grow and who grows along with you, and what the both internal and external impacts are of that, and that the market. I mean, if you look at the direction that public market investing in public market assets are going, they are increasingly ESG mandated. Plenty of debate over what that means and how effective that framework is, that needs to be sorted through. But even the fact that there are frameworks and that this is a conversation and an imperative is really different than where we were 5 years ago. And so I think that if you sort of map the trend lines around that, it's very clear that whatever, as we sort out like what that means to be ESG compliant, like that will be an absolute prerequisite for the majority of public market capital. And so again, if you're sort of a private company, a startup raising funds now, we think the best thing that you can do is plan ahead for that. It is both the right thing to do sort of morally and the right thing to do financially. That's sort of how we think about it.
Other questions, or otherwise I have some more. So
No, so Johannes Ernst asks, how do you enshrine those values, especially as more investors come on, as there's executive turnover? Give us that. There's a bunch of founders in the room who are struggling with this right now. What do you do?
What do we do as investors to help them? Is that right? I think it's about being a true partner from day one. It's helping them on that journey. Like you said, you start earlier, trying to instill these values from day one, helping them say, when we run our ESG report, don't just give us the raw data. Let us show you how we calculate this information. Let us be a partner with you on this journey. And if you do that consistently, I think you're going to instill a set of values and an ethos from day one that will last as the company changes, right? You have to start from the beginning. And that's why I think we like investing kind of earlier on at the Series A. And if you can do that, you'll build a very lasting, sustainable company.
I think a larger point is that I can't be like the fail-safe for your company to make sure you're like aligning with your ESG values. And you as a founder can't be either, because you might not be there. Something might happen, or you never know. And so I think for us, the real focus is on ensuring that there's a larger team around the founders that are also very responsible, very thoughtful, who are values aligned. So that means growing your C-suite soon, growing your investor base quickly, ensuring that you have lots of really good people around the table, because the idea that like you as a founder are going to be the one doing this forever is not true. And so I think that's what we really focus on. It's of course corporate governance, but it also is just like, do you have really good people around you other than me who are helping you think about this stuff?
Yeah, I think it's largely about intentionality and helping set that intent and help them put write the culture down. Even when we do our memos, we talk about the kinds of things that we want to look into in terms of that alignment across their stakeholders, whether it's employees and partners and customers as well as their shareholders, and what are the intents around that, and how do you help them stay true to those intents.
I would just really quickly say that it's how you design your systems. What you're recruiting systems are set up to look like, what your performance evaluations reward. Like that's how you keep to the values when you're not in the room. And that's the earlier you can do that, the better.
Maybe just one caution though. I would say many of our most world positive companies have experienced the most difficulty with employee expectations and investor expectations. Like if you go out there, I think especially as perhaps a minority founder, woman founder, and you're like, we really care about this stuff. And you have, you know, you do your first report and like 40% of your company are women and people of color on the founding team, but you've like led with these values. A lot of times, and this is a gross generalization, but your Gen Z employees are going to be like, why wasn't it 55? You know, why wasn't it 60? Or like, please delve into that more deeply. And how many of them are Pacific Islanders? And like, these are very legitimate questions, but like, we joke internally that like leading with ESG with your employees can often just be like asking to get punched in the face. And so I would say it's just be aware that like you should be living these things authentically, but it is a lot of companies don't want to do it because it's a difficult conversation. If you didn't say anything and people looked around and said, wow, like 40% of this company is diverse, they'd be like, that's awesome. But if you set standards for yourself, people are going to hold you to them. And they may have unreasonable expectations as part of that as well. And so just being aware that it is not just like you pursue diversity and everyone's like, you're doing a great job. Like they might not. And so just to be aware of that.
What a fantastic conversation. Lots more that a lot of threads we could continue to pull there for a while, but I want to say thanks to our terrific panelists. Thank you for the time. You can see why we invited these folks. Super, super interesting and thoughtful group. We're going to take a break now till I think about 20 after the hour. So grab some coffee and we will see you back here in a few minutes. Thanks very much.
Thank you.